Hi everyone. Today we're going to be talking about what's going on with Netflix. Over the past week, the share price has dropped from a whopping high of $350 to $190. That's a fall of 43%. More than $55 billion has been wiped off the market cap. This was after it was revealed a sharp drop of around 200,000 subscribers. Netflix has also warned more than 2 million people are set to quit the streaming service in coming few months. For those of you living underneath a rock and don't know what Netflix is a popular subscription-based streaming service started up in 1997, offering customers movies, TV shows whenever they wanted, without the hefty cost of premium cable. Netflix is known for releasing all the episodes of a season at once, unlike traditional TV shows where viewers have to wait week by week, meaning customers could binge entire seasons all at once. They've had hit productions such as Ozark, Stranger Things, Squid Games, and Mindhunter. From 2012 to 2022, it has amassed 222 million subscribers in over 190 countries. It was profitable for the first time last year. During the same time, share prices increased from $10 to around about $612. That's a return of over 5,800%. If you had bought 20,000 shares of Netflix at the beginning of 2012, they'd be worth $1.186 million at the end of 2021. Revenue has been increasing year on year, $3.8 billion in year-to-date 21 to $4.9 billion in 2022, but growth has slowed down. Revenue growth in 2022 was only 15% compared to 23% the previous year. This is down to growth in the US and Canada markets, one of Netflix's biggest markets, and it's slowing down. Next, we're going to take a look at what's causing the slowdown in growth. Well, why the drop? Netflix has increased their prices. The premium package has increased from $17.99 to $19.99, resulting in 600,000 users leaving the platform. The firm had to put up prices to increase revenue, which always leads to a drop in subscribers, but also means it's making more revenue per customer. Another reason is inflation. The cost of goods have increased. This has been driven by demand, monetary policy, and global supply chain issues. With costs of everyday items increasing, customers are cutting back on non-essentials such as streaming services to save money. One of the other reasons, intensifying competition. Since launching in 1997, many of US's largest media companies have tried to copy Netflix's success. Some of these include Hulu, Disney+, Warner Bros. Discovery HBO Max, NBC Universal's Peacock, Paramount Pictures, Paramount+. The truth is, these companies have big pockets and are ready to spend even more money. Just to give an idea of the levels of investment, from 2018 to 2021, Netflix invested $55 billion into TV shows and movies. Just to put that into perspective, that's more than what Australia spent on defense in 2021. This triggered other companies to do the same. Amazon spent $1 billion on a single TV show in 2019, Lord of the Rings, and this was at the time the most expensive show in TV history. The COVID pandemic has caused an increase of potential customers that wouldn't otherwise be there. Other players have also entered the market wanting a piece of the pie. US media groups will spend upwards of $100 billion on content this year. Netflix is roughly around about 17% of that, so $17 billion. Wall Street is recognizing that streaming is becoming less and less profitable. In 2021, when Paramount announced investment plans for Paramount Plus streaming, the share price dropped by 20%. This is simply due to the sheer amount of investment for making new shows and movies. While Netflix has the advantage of a large existing subscriber base, other major platforms have the advantage of fresh shows and movies that viewers can't find on Netflix, and franchises such as Star Wars and Marvel. What made Netflix stand out is now perhaps a weakness. Netflix has a habit of releasing a series at once and ending franchises after about 3 seasons. For example, Mindhunter, The Punisher, Daredevil were all popular shows that were ended way too early. Whereas platforms like Disney are keeping members hooked with new episodes releasing week after week, linking with content that spans film, games, and merchandise. Research shows demand for providers such as Hulu, Apple TV+, HBO, and Disney+, are now higher than Netflix. Another reason is a maturing English market. Growth in the United States and Canada, which is one of Netflix's biggest markets, is slowing down due to a maturing market, as well as competition from other providers. Another reason? Exiting Russia. Many companies have decided to exit Russia due to the war in Ukraine. and this has cost Netflix over 700,000 subscribers. So, what can Netflix do to get back on track? One of the options is to pull back on some of Netflix's spending growth. Although Netflix will still spend more than rivals, reducing investment and spend will increase profitability in the short term. One of the other suggestions made by management was to introduce advertising. A lot of customers have left because Netflix has raised its prices. A cheaper version with ads could be available in around 2 years or so. This could mean that many customers that left could come back as they will pay less for a different version of Netflix, which means more customers. And this also means more revenue with ads, which Netflix doesn't currently have. Some analysts have even suggested improving the quality of the shows. As I said earlier, many customers are starting to prefer other providers. For the amount that's being spent on content production, there isn't much interest or stickiness, especially in the English markets. Part of this could just be because customers have so much more to choose from. As mentioned earlier, growth in US and Canada, one of Netflix's biggest markets, is slowing down. But still, there was around 25% growth in revenue in EMEA, that's Europe, Middle East and Africa, and 38% increase in Asia Pacific. Together, these markets represent around 45% of revenue. Growth in these two markets could make up for the stagnant US and Canada markets. And financially, Netflix isn't too bad. Operating margins are around 20%, increasing from 14% in 2020. The return on equity is 29%. That's a rare feat for a lot of companies. Essentially, $17.5 billion in equity is generating around $5 billion in net income. Netflix still has a larger subscriber base, is still spending the most on new shows and movies. It's just now operating in a tougher market with many more competitors with deep pockets. It's hard to judge what the future will look like. At this point, all other streaming services are trying to become Netflix. Netflix is a global player, having hit shows travel across tens of countries, a feat rarely achieved. As well as introducing ads, improving the quality of its shows, reducing spend, cracking down on password sharing, increased investment into international markets, especially APAC and EMEA, is key if Netflix is to keep up its growth. Remember, EMEA and APAC make up 45% of revenue, and it's still growing. In the next episode, we'll be looking into Netflix's ratios and financial fundamentals, and trying to come up with an estimate of what the share price should be based on the different information we have. If you like the channel, please subscribe and drop a like below. It's the only way I can keep making new content. Drop a line on what topic within investing and finance you'd like me to make a video on, or company you'd like me to look into. Thanks for listening. Until next time, take care.